Hello everyone, welcome to Demand Supply Trading Practical Session number 35 for the year 2024. Myself, Srijit Kakkar, and today is Sunday, 15th of September 2024. And before we move ahead, let's also get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation risk disclosure, risk involved in the market, and also about the copyrights. So today's session is our practical session, but yes, before we get into it, a quick reminder, we have a channel on WhatsApp now, and this is where we keep updating you regarding our upcoming sessions, our latest videos, or if we have any promotions coming up, we also keep updating you. So to join this channel, you can scan the QR code which is available on your screen. Otherwise, the direct link is also available in the description. You can use that link to join this WhatsApp channel. Now, coming back to today's session is a practical application of demand supply methodology. So our demand supply methodology course used to be a paid course, but now it is available absolutely free. So in case you people have not yet gone through the course, the links are available in the description. Course is available in two languages, English as well as in Hindi. So wherever is comfortable for you, you can go through that language. You can learn the complete methodology. Nothing is missing. But the course covers the methodology theoretically, right? Which is where you'll be understanding what is demand supply, how to apply it, right? So we are going through the theory part. Now to get better with the application, you need to go through the practical sessions, and that is what we do every weekend. So every weekend I take a practical session where we take an example, and to that example we apply the complete methodology so that you people can understand how to plan trades in a very mechanical and rule based way. Now the best part about these sessions is that when we are doing the analysis, we are not looking into something which has already happened and then just simply applying the methodology, and it's more like doing a postmortem, which I'll say is very easy, because something which has already happened, you can apply any indicator, any oscillator, any strategy, and you can come up with a number of reasons that this is where you would have bought or this is where you would have sold. But what we are doing is we are doing our analysis in advance. So it's not something which has already happened. It is about something which can happen in the future. And that is the beauty of the methodology. That is the beauty of these sessions, that I'm pre-planning these areas for you. And just because I'm pre-planning, it does not mean that I share these trading ideas with you. Not trading ideas, I'll say examples with you, and then we forget about it. Whatever examples I share with you, whenever they get triggered in the future, we also review them, and that helps you see how the methodology has been performing. And that also helps you build confidence in the methodology, which is very, very important, because unless and until you have confidence in a methodology, we don't start practicing it, right? So to practice it, first we need to have full faith, we need to have that confidence, and that is what these sessions are designed for, that you go through a number of sessions, you see a number of sessions, and once you see the outcome that you get from the methodology, by default you'll start building up your confidence, and then you'll try to shift to this methodology, or maybe use it along with whatever you have been doing, so whichever way you wish to go through. All right, now before we start with our example for today, we do have one example which got triggered during the week. So like I said, because we are planning in advance does not mean that I share with you and then we forget about it. Whatever gets triggered, we do review it. So today we have one example which is for review, and this is from the previous session. So in the previous session, which was session number 34, we did the analysis for the zone. Now when we did the analysis, it was on the 8th of September. And at the time of analysis, this was a type 2, type 3 trade for us. And even during the analysis, I talked about that we have our opposing zone, which is sitting right above, and that's not a good reward to risk ratio for us. So the only time we'll have a good reward to risk ratio is if the prices, they come back into the zone, test the zone, and then give us the entry. Now we came pretty close to the zone, but we did not hit the zone. So unfortunately, the zone was not tested, even though we came pretty close to it. So this would have been our target one, which is not a 2:1, and that is what I talked about, that if you don't see a 2:1, this will get disqualified. Otherwise, you can see we definitely came into the zone. We are getting some reactions from there. Prices have definitely reversed from our area as of now, but because of bad reward to risk ratio, we'll mark it as not a qualified trade, because like I said, as a rule based trader, we need to be very strict with our rules. And as we understand that every trade is not going to be a profitable trade, we will have winners, we will have losers. So we need to ensure that whenever we are entering a trade, we have a clear at least 2:1, so that even if I'm wrong, let's say 50% of the times, I can still be a net profitable trader, because your hit rate never keeps you profitable. You can have a hit rate which is 90%. You can still be a person who is into red if your reward to risk ratios are not good. But if you have beautiful reward to risk ratios, you can have a hit rate which is like, let's say, uh, 30%, 40%, 50%. Still, you can be in the green because you are planning trades for good reward to risk ratios. And that is a very, very important aspect. I've also covered this in a video which is called as reward to risk ratio. You can find that video on my channel. You can go through it. That will help you understand better why reward to risk ratio is a very, very important aspect of any trading methodology. So again, this one, because the RR was bad, this would disqualify, and that's the only uh, example which got triggered. So like I said, we did the analysis on the 8th of September. Prices came back into the zone on the 11th, but because of bad reward to risk ratio, yes, if the prices would have gone tad above and would have already tested the zone, it would have been a valid trade for us, because that would have opened up the reward to risk ratio for us. But as if now, the RR was not really good, not even 1:1. All right, so that takes care of the only example which got triggered. And now that we are done with it, we can start with our analysis for today's session. So in today's session, you will see that we will have a zone which is in a way qualified for us, but I'll still show you some modifications which I do. I have shared a similar case some time back. I can't recall which session it was, but what I do is, whenever I get into these practical examples, I also share my personal approach, because like I always say, every trader has a different personality style. Some people are aggressive, some people are conservative, some people are extra conservative. So me being a little on the conservative side, when I see particular factors on the chart, at times I do make some modifications. So we'll talk about what that modification would be in this case. And again, is that mandatory? The answer is no. Like I said, every trader has a different personality style. If you wish to make those modifications, yes, you can. If you don't want to make those modifications, again, it's your call. But at least I try to show you my approach wherever I make some modifications, just because I'm on a little conservative side when I'm planning my trades. All right, so let's get started with today's session. So whenever we talk about trading, I always say trading has to be a very mechanical and rule-based process. And why it should be mechanical and rule based, I have explained this in a video. The title of that video is How to Start Trading. The link is available in the description. Again, I'll add during the session, if I talk about some documents, if I talk about some videos, everything is available in the description. So not to worry, where do I find them? Just go to the description, read through it. You'll be able to find all the relevant links. So yes, like I said, trading has to be mechanical and rule based, and it is very easy to say, yes, we have to create a trade plan. But when you're learning a new methodology, or when you've just started with trading, it's not as easy to create a trade plan, because to create a trade plan, first you need to have good enough experience of that particular methodology. And this is where this ready-made trade plan which I'm sharing with you comes in handy, and that can be your starting point. So using this trade plan, you can start planning your trades. And as you gain more and more experience, you want to make some modifications to it. Those modifications can definitely be done. So this trade plan is basically two documents. The first one is called as your trade plan steps. You can call it as the walkthrough or the flow chart, which guides us what we need to do as a demand and supply trader step by step. Now, every step has its own elaborate rules, and those rules can be found in the rule book. Again, the links are available in the description. Now, mind it, this rule book that I've shared with you is a conservative approach. With time, with experience, you want to modify it. Absolutely, that can be done. But at least you do have a starting point to start planning your trades very mechanically and rule based. So what is our step number one whenever we start planning our trades? Step one is we need to define our trade purpose. So now the question is, what do we mean by trade purpose? Trade purpose basically implies the expected duration of the trade. And the duration of the trade is from the time you enter the trade to the time you exit the trade. So now the question is, why are we starting with the trade purpose? The answer is, whenever we do our analysis, the charts that we use, they are time-based charts, and we have a number of time frames available to us. So it's not, because we have so many time frames available to us, it's very confusing that out of these a number of time frames, which time frame should I be using for my analysis? That's the very first challenge. And it's not that we can just randomly pick any time frame and start doing our analysis. So again, we need to apply a very logical approach, and that is the reason we start with our trade purpose first. So the logic we apply here is that the longer we want to be in the trade, the bigger the time frame we should be using for our analysis. And similarly, the smaller I want the duration for the trade, the smaller the time frame I should be using for my analysis. Now, when I'm talking about the exit here, the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, the exit can also be the stop loss, any kind of exit. So What I've done is I have divided these trades into four different purposes, and we call them as hourly income, daily income, weekly income, monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, by definition, I say daily income is a trade which can last for a day or few days. But if you're trading markets which are not 24-hour markets, then I'm pretty sure all of you would have experienced whenever the market opens, some symbols they gap up, some they gap down. Now, because of this gap up, gap down, what can happen is if you get a gap in your favor, you might get profit, which is bigger than what you were expecting on that trade. But if you get a gap against you, you can also lose more than what you were willing to lose on that trade. So we understand that whenever we keep a position overnight, by keeping that position overnight, we are taking that unnecessary overnight gap risk, which cannot be avoided. So this is where my recommendation to all of you is that initially our hourly dailies should be done strictly as intraday trades. We don't want to take that unnecessary overnight gap risk. Now for weekly monthlies, anyhow, we are not expecting that we'll get the exit the same day. So here we have no choice. We'll have to keep these positions as overnight positions. But again, that does not imply that for weekly monthlies, you cannot have a gap against you. It can still happen. But since you're leaning against some bigger time frame, the probability reduces. Plus, bigger the time frames, the wider the zones are. So even if you get a gap, at times prices might gap a little deeper into your zone, might not gap beyond them, but still you do have that gap risk involved. So again, initially hourly dailies, strictly intraday, weekly monthlies, we have no choice. We'll have to do them as overnight trades. But with time, with experience, if you want to include daily incomes into overnight trades, absolutely acceptable. Nothing wrong with that. But don't do it early on, because initially there will be lack of experience, due to which you might make quite a few mistakes in your analysis. So we don't want to take that unnecessary overnight gap risk unless and until you're very confident with your analysis. So step one is I need to define my trade purpose, and let's assume I opted. I want to plan monthly income trades. Now, once I have selected my purpose of trade, what is going to happen? From the rule book, I'll get to know what time frames I should be using. So if you go to page number 28 in the rule book, we start with the topic, which is multiple time frame analysis, because demand supply methodology is not based on single time frame. Demand supply methodology is based on multiple time frame analysis. So what are the multiple time frames we use? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis, intermediate is used for trend analysis. On the lower time frame, we identify areas of demand and supply for our entries and exits, and the refining time frame can be used for multiple purposes like fine-tuning the zone, different kind of entries like your type 2 type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for all these 4 different trade purposes, what will be my 4 different time frames? And the answer comes from this table. Now mind it, the table which is on page number 31 is specifically for the NSE market, because it's open for a very short duration, which is about 6 hours and 15 minutes. But if you're trading markets which are open for longer durations, like your commodities, forex, cryptos, then you can refer to the table which is page number 32. But since I take the examples from the NSE market, I'll be referring to this table. Now, I want to plan monthly income trades. So as a monthly income trader, my time frames are monthly, weekly, daily 60. Monthly is the higher time frame, which is used for curve analysis. Weekly is the intermediate, used for trend analysis. Lower time frame is daily. That is where we get our SCTS from. SCTS stands for stop loss entry target and size. And in case I need to use the refining time frame, then my refining time frame will be the 60 minutes chart, which can be used for multiple purposes like fine tuning the zone, type 2 type 3 entries, or in case I need to apply some additional rules, that is also where this time frame can help us. So as soon as I am done with my step number 1, I have the clarity to what time frames I'll be using, plus what analysis I will be doing on each and every time frame. So I have the clarity to it. My challenge number 1 is taken care. Now the next challenge is, yes, I do know my time frames, but on the NSE exchange, we have about 2000 plus companies listed. So humanly not possible that every day I sit and analyze 2000 companies. So the next step is I need to have a process in place which can help me select some symbols from this big list, because if I have a small list, I can do my analysis almost every other day. But if I don't have a small list, going through 2000 symbols every day is not an easy task. So how do I get my small list? For this, we use certain computer programs which are called as scanners or screeners. And the way these computer programs, they work is that we input certain conditions into them, that these are the conditions I'm looking for. And then that program identifies that out of these n number of symbols, which symbols are matching with those conditions. And whatever is matching with those conditions, it gets shortlisted for us, and that is how we get a smaller list. Now, very, very important thing you have to remember, irrespective what scanner or screener you're using, whatever results you get, you can never blindly buy or sell those symbols, because the scanner screener never tells you what you need to buy or sell. The scanner screener only helps you get a smaller list. Once you have that small list, you'll have to analyze each and every symbol individually. And whatever matches with your trade plan would be your opportunity. Whatever doesn't match with your trade plan, you simply skip it. So remember, job of the scanner is never to tell you what you need to buy or sell. The job of the scanner is to give you a smaller list so that you can manually analyze it. Now, a few examples of these scanner screeners. Example one, if you go to my website, you will see under the free tab, I have created a scanner for you. And those scanners are based on some moving averages, helping you shortlist some symbols based on moving averages. Second example, on my YouTube channel, if you search for scanner, you'll be able to find a few videos, different scanners, different logics. You like any of those, you can use that. Third example, on my YouTube channel, search for sector analysis. You'll be able to find a video on sector analysis, which can again help you in shortlisting symbols. Fourth example, on my YouTube channel, search for top-down analysis. You can even find a video on top-down analysis, which can help you in shortlisting symbols. So these are 3-4 different examples, but you're not restricted only to these 3-4 different scanner screeners. So let's look at few examples before we move ahead. So like I was talking about, that once you come to our website, under the free tab, you have stock screener. Because I want to plan MIT trades, I can run the long scan and the short scan. So here you can see the long scan is shortlisting about 11 symbols for me, and the short scan is shortlisting nothing for me. So this can happen at times that maybe nothing is matching with these conditions, and if nothing is matching, nothing is going to get shortlisted for you. Now, what happens is, if you have a very small list, like you can see, we have a list of only 11 symbols, the probability of identifying something which is in sync with your trade plan definitely reduces, because the smaller the list, the lower is the probability that something might match with your trade plan. So if you want that, you should always get a little bigger list, or in case if you're not getting any results and you want to get some results, then what you can do is, in this scanner, you can see I have given about 5 conditions. You will disable the third one, you will run the scan again, and similarly I'll do exactly the same thing for the short scan. I'll disable the third one, run the scan again. So initially you saw that it was giving me a list of about 11 symbols, but now it is giving me 102. And the short scan was not shortlisting anything for me, but now it is giving me 18. So initially I had only 11 symbols to look into, but now I have 102 plus 18, which is 120 symbols to look into, which is still a very small list. I won't say that it's a very big list. 120 can be easily analyzed probably in about half an hour or 45 minutes. But yes, now you do have a list which is a little big enough for you to probably find something which matches with your trade plan. Now, if you still feel it's a very big list and you further want to filter it out, you can use different filters. Example, I can say I don't want from the cash segment. I only want the ones which get traded in futures, or I want from my Nifty 50, or I want from my Nifty 500, or I want from my mid cap, small cap, right? So this is how you can apply different filters. So example, if I change this to futures, you can see now from 102, I'm down to only 23 symbols. So you can choose it as per your preference. Plus, this is not the only screener which is available to you. If you go to the screener section on this website, you can see you have over 150,000 scanners available to you. Some are based on fundamental analysis. Then you have your top left, you have your candlestick patterns, you have range breakouts, you have your bullish scan, you have your bearish scan, you have intraday bearish, intraday bullish, crossovers. So you have n number of scanner screeners available to you. And this is just one website. If you do a Google search, you'll be able to find a number of websites, a number of scanner screeners. So wherever you feel is the best fit for you, you can use that. Because remember, scanner screener, they never tell you what you need to buy or sell. They're only helping you get a smaller list, right? So wherever you feel is more in sync with your thought process, you can use that scanner. Now, in this case, you saw that we got a list of about 120. Now, once you start analyzing them, there are a few more challenges which you will eventually realize. So let's talk about those challenges and what are the solutions to those challenges. So challenge number one, you'll realize is that out of these 120 symbols or whatever list you get, a majority of them, they don't have a quality demand zone or a quality supply zone on the lower time frame. And if you don't have a demand zone or a supply zone, you don't have anything to lean against to plan your trade. So in a way, you will be wasting a lot of time analyzing such symbols where nothing tradable is available, right? Which means a lot of time wastage. The second challenge is that some of these symbols, even if they do have some quality demand areas and supply areas, those quality demand supply zones might be far away from the current market price. So the challenge here will be, because they are far away from the current market price, you'll have a longer waiting period before the prices are back into your zone, because that is the only time we can participate. And during that waiting period, whatever price action happens, it might even disqualify the trade setup for you. And you might have to skip that trade after a very long wait. So these are some of the challenges you face when you are using scanners which are based on conventional technical analysis or fundamental analysis, because all these 150,000 scanners I talked about, none of them have anything to do with demand zones or supply zones. And the solution to it is, we do have some custom built tools designed for you. One is called as the alerts, the other one is called as the screener. Now, how do these alerts and screener they basically work? Let's also understand that. First of all, I'll add that the walkthrough videos which explain them fully, the links to those walkthrough videos are available in the description. You can go through walkthrough videos to understand them better. And plus, also remember, these are not call giving or tip giving services. These are scanner screeners. The only difference is that these two scanner screeners are purely based on demand supply zones versus conventional technical analysis or fundamental analysis. So if you talk about alerts, the way the alerts they basically work is, so I'm showing you example of our alerts demo channel. So we have demo channel for NSE, MCX and Forex, where we give you alerts during the live market for about half an hour. And I'm showing you example from the NSE alert demo channel. So this is for the 13th, which is Friday. So you can see, as and when these demand and supply areas are getting formed, you keep getting these notifications. Now, what information is available on those notifications, at what time the zone has formed, on which symbol the zone has formed, what is the structure, on which time frame the zone has formed, what is the proximal value, what is the distal value. So you can see in real time, as and when these demand and supply areas are getting formed, you get these notifications. Now, just because you got these notifications does not mean you will blindly buy or sell at these demand and supply areas. Like I already said, these are not call giving or tip giving services. These are scanners which are telling you, okay, on this symbol, on this time frame, we have a formation of a zone. Now you will have to go to that symbol, you'll have to go to that time frame, and then you will have to qualify that demand area or supply area with your trade plan. Only if it qualifies, it might be an opportunity for you. If it doesn't qualify, you simply skip it. So that is what the alerts they basically do. They keep updating you live as and when the demand and supply areas are getting formed. Now, talking about screener. Now, how does the screener works? Just give me a second, please. So here you can see I have screener applied to this chart, and in this screener I have given a list of about 40 symbols, and then I've given my settings that I want my proximity to be 1%, which means out of these 40 symbols, whichever symbol is within 1% to a demand area or a supply area, shortlist for me. So can you see, out of those 40 symbols, it is only shortlisting these 4 for me. So in a way, 36 I don't even have to analyze. Can you see, it saved me a lot of time. And these are the ones where I'm actually very close to demand areas, right? So that is where I can try it and go and verify whether any of these they match with my trade plan. So example, if I go to TechM, which is the first one getting shortlisted for us, you will see that my current candle will be close to a demand area, and that is the reason it is getting shortlisted. You can see the current candle is pretty close to it. And let's take another example. Let's say I go to Infi. So you will see on Infi, I will also be close to a demand area, and here you can see we do have this demand zone, and my current candle is pretty close to it, and that is why it got shortlisted for us. Plus, once you have created this list, you can use it on multiple time frames. So example, from daily, if I change it to weekly, now it will give me results based on the weekly time frame. You can see the ones which are getting highlighted in red are closer to supplies, the one highlighted in green are closer to demands, and that is what the screener does for us. It helps us identify symbols where we are closer to these demand areas or where we are closer to these supply areas. So that's the difference between the two. Alerts, they keep updating you as and when the zones are getting formed. During the live market, screener, it updates you during the live market where we are getting closer to the zone, be that zone has formed today or maybe a day ago or a week ago or a month ago or a year ago. As long as we are in that proximity range, it will shortlist for you. So again, I just showed you a number of ways of shortlisting symbols. I showed you over 150,000 scanners on one particular website, two scanners which are based on demand and supply. The process can be as simple as I don't want to use any of these scanner screeners. I want a small list. I will only be analyzing my Nifty 50 stocks, or maybe I have my own favorite list of symbols which I want to analyze. So choice is yours. How you get that small list. But once you have that small list, now we are ready to move ahead because we already know our time frames from our step number one. And now we also know which symbols we'll have to analyze. So we'll analyze them one by one. Whatever matches with your trade plan is an opportunity for you. Whatever doesn't match with your trade plan, you simply skip it. So let's assume the very first one was ABC. So we'll start with ABC. We'll go to the lower time frame. Now, what is my lower time frame? We got to know that from our step number one, that as a monthly income trader, my lower time frame is daily. So here lower time frame implies daily time frame. That is where I have to identify zone, and by zone we mean any of these four structures. So let's go to our daily time frame. And on the chart, you can see I have already applied the demand and supply zone indicator, so I don't have to identify the zones. The indicator is doing automatically for me, also plotting the zones for me. Now, minded, the demand supply zone indicator is definitely a subscription based indicator, but we do have the demo version available for it. So if you want to try out the demo version, just go to the indicators on TradingView, search for demo demand supply zone indicator. You'll be able to find the one created by me. The name of the author, Surjit Kakkar, would be written there. You can try it out. The limitation of the demo version is that you can only use it on the daily time frame. You'll not be able to use it on any other time frame. So you can definitely try it out. Plus, whenever we talk about demand supply methodology, I always say it's a price action based methodology. And that is what the indicator is designed based off. It is not based on boring exciting technique. The indicator is purely based on price action. And what do we mean by price action? Price action means the action done by the price. And what action can price do? Only two things. It can either move up or move down. Can it do anything else? But when it is moving in a narrow range, we call it as the period of pause, or you can also call it as our basing. Now, initially, when you start learning demand supply methodology, let's assume you don't have access to the demand and supply zone indicator. You have not subscribed for it. Not to worry. You can still start with the process, which is called as boring exciting technique. And we have created the boring candle indicator on TradingView. It's an absolutely free indicator. You can use it for free forever. Similarly, we have also created the explosive move indicator, which is again a free indicator. You can use it for free forever. So both these indicators are available to you. So using these two indicators, you can start training your eyes because majority of the zones can be identified based on boring exciting technique. But as you start having more and more experience, eventually you will have to shift from boring exciting towards understanding the flow of the price, which is what is price action telling me. And the sooner you make that shift, the better you will see your results will start getting. But at least you do have a starting point, which is the boring and the exciting technique. So yes, talking about step number 3, which is to identify the zone. Like I said, the indicator has already done that process for us, and we can already see that we have a demand zone on the chart, which is this drop based rally. So my step number 3 is complete. I have identified a zone. Now, just because you have a zone available does not mean you can blindly trade it, and that's the biggest mistake demand supply traders they make initially. They find any demand area, blindly start buying on it, find any supply area, blindly start selling on it, which is incorrect. Once a demand zone or a supply zone has been identified, the next step is to qualify it, which is a two-step process. In step 1, we'll qualify it based on certain conditions, and in step 2, we'll qualify it based on the booster scoring. So the first condition we'll check is that can this zone be a case of level on top of level? Now, how do we verify that? It's a very simple concept. If you have an intermediate time frame zone and the same intermediate time frame zone divides into multiple zones on the lower time frame. So again, when your intermediate time frame zone is dividing into multiple zones on the lower time frame, we call it as a case of level on top of level. So the first thing we understand here is that to be a case of level on top of level, my lower time frame zone has to completely coincide with the intermediate, right? Only if it is a coinciding level, it might be a case of level on top of level. But if it is not a coinciding level, it can never be a case of level on top of level. So let's verify that the zone we have identified, can this be a case of level on top of level or not? And the reason why we are starting with level on top of level as the first condition is because if it proves to be a case of level on top of level, we might have to make some shift, right? So that is the reason we always start with level on top of level. So once I go to the intermediate time frame, you can see we do have an intermediate time frame zone, which is right here. I'll mark it with a different color. Let's mark it as pink. Now the one in pink is your intermediate time frame zone. The one is green is your lower time frame zone. So is my lower time frame zone inside my intermediate time frame zone? The answer is no. Can you see it's not completely inside? To call it as a coinciding level, it has to be completely inside, not partially inside. So since it is not a coinciding level, it cannot be a case of level on top of level. So the first condition we have checked, it's not a case of level on top of level. This zone is not because of a gap, therefore will not apply gap rules. Pivot non-authenticity definitely applicable because to a drop-based rally or a rally-based drop, we always apply pivot and non-authentic rules. Now, what are the rules for pivot non-authentic? If I go to the rule book, you will see I've given you two different approaches. The first one is the aggressive rule. Aggressive rule says that even before you start applying the boosters, make sure the move from the zone was able to violate at least one opposing zone on the intermediate time frame. So what does this mean? Because I know that it might be a non-authentic zone, I want to ensure it has strength. And how can it show me strength? If this move to the upside has violated an opposing zone. So if this is demand, it needs to violate a supply area. And because I want to see strength, I want to see violation of not same time frame zone. I want to see violation of a zone which is on a bigger time frame, intermediate time frame, which basically tells me that, as an analogy, a kid has been able to defeat an adult, which means the kid definitely has extraordinary strength. So let's go to a weekly chart, which is intermediate time frame, and see was the move from the zone able to violate some opposing zone. And the answer is yes. If I hide this candle, you can see that we did have some supply areas here, and you can see the move from the zone was able to violate these areas when the prices they started moving up, right? So we need a violation of an opposing zone on the intermediate time frame, which has definitely happened. And based on the aggressive rule, this zone definitely gets qualified. So that's your aggressive approach. Now talking about the conservative approach. Why? Because here we are looking at two conditions. Condition number one, we need to have an impulsive move on the intermediate time frame. Condition number two, we need to have an authentic zone on the refining time frame. So do we have an impulsive move? The answer is yes. You can see these were your last pivot highs. Prices have definitely breached it and make new highs, which basically is called as an impulsive move. So my condition number one is true. Condition number two is on the refining time frame. We need authentic zone. Authentic means rally-based rallies. So you can see we have a rally-based rally here. We have another rally-based rally here. So not just one. In fact, we have two authentic zones inside of it. So definitely, irrespective whether you're applying the conservative approach or the aggressive approach, in both the cases, this zone is qualified for us because based on the rules we apply for pivot non-authenticity, this is a qualified area. Next, unstable equilibrium is not applicable. So after applying all the applicable rules, is the zone qualified? Answer is yes. Now that we know we have a qualified zone, again, does not mean we blindly trade it. The next step will be the boosters. So let's understand the quality and the probability factor. So talking about quality, freshness, the zone is definitely fresh, gets a score of 3. Talking about strength, now I have said this many times because I only trade MIT trades, and since we are on bigger time frames, I don't mind even a single leg out pattern with a good strength. So I would like to check, is it also an explosive move? So if I change it to explosive, you can see the indicator is still identifying it, which means this will categorize as an explosive move. And for explosive move, I'll give it a score of 2. Time at the zone, we only have one candle, gets a score of 2. Reward to risk ratio will take as an assumption. Next, what is the location? If I go to the monthly time frame, because that's my higher time frame, you can see that my zone is located in this gray shaded area, which is middle of the curve. So middle of the curve gets a score of 0. Talking about the trend, the indicator is telling us we are in an uptrend. Here you can see we have violation of two supply areas, and violation of two supply areas will make it as an uptrend for us, because if the prices are moving up, they can only do it by violating supply. Supplies are not holding, getting violated. That makes it as an uptrend for us. And since we are located middle of the curve, it will get a score of 0.5. If we were low on the curve or very low on the curve, this would have been a score of 1. But since our location is not very conducive, we don't give it a score of 1. We definitely take 0.5 out of it. Next, move from the zone, we need minimum 4:1, which has not yet happened. So you can see we probably have maybe just about a 1:1 move. So we require a 4:1 move, which has not yet happened, gets a score of 0. It is not a case of level on top of level, not even coinciding. We have already verified it. And even if you talk about trap, you can see that wherever the proximal line is, almost this area has been working like resistance, 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 resistance. In the past, you can see not very neatly working like support. And if I go further back, you can still see it working like not very clean, right? You can see here we have a lot of whipsaws. So it's just that the very recent history, which we look into, that is where it has been working like resistance. Ideally, we need a very clean area which looks like an area of support and resistance. So I would like to give it a score of 0, not a score of 1. So if you look at an overall scoring, we have a high quality zone, definitely with the assumption of reward to risk ratio. But a low probability setup, so high quality, low probability can only be done as a type 2 or a type 3 trade. So now we know that this only qualifies as a type 2, type 3 trade. Next, what we need to do is we need to do our position size calculation, because no matter how high the quality or the probability, we understand that any trade can be a stopped out trade. So in case it doesn't go in our favor, we should not lose more than what our risk management rule allows us to lose. So that is the reason you'll have to do your position size calculation. Whenever the prices are back, you'll have to re-verify, because markets are not static, markets are dynamic, conditions are changing almost every other second. Like you saw the example, which was session number 34. If the prices would have gone just a tad above, it would have been a qualified trade for us, because the reward to risk ratio would have opened up. But because it missed hitting the proximal line of that supply area, it was still a trade which got disqualified for us because of bad reward to risk ratio. So these conditions can change, and that is the reason you'll always have to re-verify before the prices they are about to enter the zone. And if it qualifies, you place your order based on the entry type. And once your order has been executed, last step is your trade management, where step 1 is 1 we make it as a break even trade. And after that, if we get the opportunity to trail onto it, we start using our trailing stop loss. And that is how we plan trade in a very mechanical and rule based way. So like I was talking about at the starting of the session, that this will be a qualified trade setup for us, but me being a little on the conservative side, I would have made some modifications to it. So let's talk about what modifications I would have made, and also the reason behind it. Now, the very first reason is, you can see when I was talking about area of support and resistance, I said, okay, this is where we have this as an area of resistance. And you can see probably that is where we have the breakout of that resistance area. And if you go to the rule book, you will see that I have given you a rule which says that your demand supply zones which are formed at almost breakout levels are a little lesser probability. Now, why are they a little lesser probability? Because if you think about it, this is where we have our breakout. So people who believe in support resistance, they will say, okay, we have a breakout, now this should act like support, and that is also they'll be buying. So when we are buying, a lot of people who follow conventional technical analysis would also be buying, which does not give us an edge, right? So to have that edge, we want our areas should always be a little lower, so that they can work like areas of trap. So that is the reason this is something which I don't like, because I know that this will not have that edge, that it might work like a trap, because wherever I'm buying, a lot of other people would also be buying. So my modification here would be, because when I was looking at the weekly time frame, I saw that we do have a weekly zone which is just a little lower. Plus, I'm also planning this trade, which is not at a very good location to be a long trader. I'm neither low on the curve, I'm neither very low on the curve. It's somewhere middle of the curve. So I would prefer to have a little extra probability coming up into my trade setup, and by going to the weekly time frame, because like I always say, the bigger the time frame, the higher the weightage. So this also gives a little higher weightage. Plus, you can see that yes, we are still overlapping a little bit. So let's assume if the prices they go a little deeper into the zone, I'm still in the trade, but my stop loss is below the distal line of the weekly time frame. And in the past, I've also shown you a similar example where I made that modification. And because of that modification, it was a profitable trade for us. Otherwise, if I would have taken the lower time frame zone, we would have been stopped out. Now, is it mandatory to make that modification? The answer is no. It's just that I'm showing you my approach, that if I see such kind of cases, what modification do I make? If you people want to make those modifications, good enough. If you don't want to make those modification, it's still acceptable, right? It's your call at the end of the day. You will have to take your sample size, look at a number of trades, and see what works best for you. Yes, the downside here can be that I might miss my opportunity, but somebody who's using the upper zone might get a beautiful reward to risk ratio, because your zone is still a narrower zone. But me, like I said, being on the little conservative side, I'm okay with missing a trade. But I always like to be a little conservative wherever possible. So that's the modification I would have made for my approach. But yes, even if you don't want to make that modification, the zone above is definitely a qualified area for us. All right, so that's the only modification which I would have done, and that is what I wanted to share as an example of how even when you're looking at the same trade setup, you might have different areas where you might want to participate just based on your personality style. Now, if this was happening, let's say very low of the curve, then probably I would have not made that shift, right? Because like I also said, it is also the location. I'm not very happy with the location. It's somewhere middle of the curve. So I want to have that extra positive factor, which the intermediate time frame will definitely give me, right? So that is where we have those modifications. But like I said, if we were very low on the curve, then probably I would have not made that modification. So again, based on a number of factors, at times I might do it, at times I might not do it, and that is why when I do these analysis, I share my insight into it and also my approach into it, so that you people can uh, eventually plan, create your trade plan, which is more in sync with your personality style. But at least you have seen different examples how things can be done. All right, now before we start with the questions we have in the chat box, let me also add that if you're liking these sessions, do like the video. And if you have not subscribed to my channel, do subscribe to it so that you get notified whenever we are planning these sessions. And also, if you have some friends, family members, or if you're on some trading groups, you can share the link to my sessions. You can share the link to my course content so that people can take advantage of it. So let's see what we have in the chat box. So the very first one is from Sunil, waiting for screener. How can I buy? So you don't have to wait for it. It is already available on our website. So you can go to our website, which is surjitkakkar.com, go to all products, and that is where you'll be able to find the screener which is listed. All you need to do is just add it to your cart, just like any e-commerce website. Go through the checkout process, and once you're done with the checkout, whatever commencement date you would have selected, from that date it will get activated for you, and you will be able to use it during your subscription period. So again, it is already available. You need not wait for it. You just have to subscribe to it from our website. All right, in white space, sideways, dead space is the same as your order answer strap. Let's say it's an uptrend, it created the rally based rally, then the price makes a sideways range movement. So I understand. So basically, these nuts are probably what you're talking about is maybe you would have taken some sessions from Sam. If I'm trying to, I'm just trying to guess. And in fact, I don't know if you people know it. Sam has been my mentor, so I believe you probably would have taken some sessions from Sam, maybe some online sessions from from YouTube, or maybe something like that. So yes, so when we talk about trap, it's basically the same concept, right? So it's basically the same thing, because what we are talking about is an area where a lot of trading has been happening, right? So that is where we would not like to participate, wherever we have these white spaces, right? So that is where we know that the prices have definitely moved really fast, and a lot of transactions did not happen. And you will see most of the times these areas will be having areas which might work like traps. So this example which we are looking at is not a very beautiful example of it, but yes, at times you will see that is what it connects with. All right, so can this indicator be automated with Python and machine learning? Absolutely, it can be done. But what I believe is that when it comes to trading, there is a human element which has to be added, right? So that is why you can see I have scanners which are shortlisting symbols for you based on demand supply. I have alert service which is doing based on demand and supply. So if I wanted, I could have created into a black box, but a black box will not work. The reason is we need to have that human element, which is experience. And algorithm can only do mathematics, it will never have experience, and that is where it lacks. And that is where I believe that the only kind of automation I can do is the zones getting identified automatically, the symbols getting shortlisted for me, but then that experience has to be added. A very simple example I can give you is if you look at the weather prediction. If you will see, these weather predictions are done by supercomputers, right? They look at n number of factors and then they give you the prediction, okay, this can happen. But before those predictions are publicly posted, they go to a weather expert, and that weather expert looks into it, and only if he says, okay, this has to be published, they get published. So again, can you see, even though those supercomputers are getting used, the human experience element is missing, and that is why it goes to a weather expert before it gets published. So the same thing applies here, that you do need to have that human element, and that is why I have not because I know even if I try to convert it into a black box, you'll not get the kind of results which you're looking for, right? So I guess with that human element, you definitely get better results. All right, so how do we use demand supply in binary trading? See, Prakash, first thing I'll say is binary trading is something I'll definitely not recommend, because it's definitely more like 100% gambling. Now, applying it will be again challenging, because at the spot you have to decide whether the prices will go up or go down in the next X number of seconds or X number of minutes or whatever it might be. But what you can do is, if you're doing it for longer duration, maybe when the prices are in your demand zone, then you can bet on maybe prices moving up. But will it happen during that time frame, that time period, or will it not happen? Nobody has control over it. How long it will take? It might spend two candles inside of it. It might spend 20 candles inside of it. You have no control over it, right? So that is why I'll say it will be a little bit challenging. But again, coming back to binary, my recommendation would be not even to get into it, because I primarily believed binary options is more like 100% gambling. All right. Go ahead and apply your tool on TradingView. So again, these tools are subscription-based tools. Only if you're subscribed to it, you will be able to apply it. The ones which are free, I've already talked about it. Boring candle indicator is absolutely free. Explosive move indicator is absolutely free. Demo demand and supply zone indicator is absolutely free. So those are the ones you'll be able to use. But if you talk about demand supply zone indicator, you're talking about the alerts, you're talking about the screener. They are subscription based. You'll have to subscribe to them. At the time of subscription, you'll have to provide your correct TradingView username, because if your username is incorrect, again, it will not get activated for you. So all those steps have to be followed. But yes, after you have done that, in case it is still not working for you, just send a screenshot to our support email address, which is info@surjitkakkar.com. We'll definitely look into it. We'll help you how to activate it. But if you're providing all the correct information, you will be able to access it. There is no challenge with it, right? It will work perfectly fine. Did you code the indicator yourself in PineScript or have a professional? I did it myself, and the reason for that is because if you are a trader, you have been trading, you understand the intricacies of it. If you have to pass it on to somebody who is not a trader and just coding something for you, then it will be much more challenging, right? Because you need to have the understanding of how things they work so that you can make it better. So I did the coding myself. So I do have a little bit of understanding of coding. Based on that, I was able to code all these tools. All right, so what is the name of the tool for boring and exciting candles? So for the boring candle indicator, just search boring candle indicator. You'll be able to find it. Similarly, for the explosive move indicator, search for explosive candle indicator and you'll be able to find it. Doubt with the intermediate time frame and lower time frame. If lower time frame and intermediate time frame is not inside, what to do? So if they are not inside, it's just not a coinciding level. Like today you saw example, it was not a coinciding level, but it is not mandatory that it always has to be a coinciding level for me to trade. Now let's assume that your trade plan is such that you will say that I always trade coinciding levels. Then this is not a valid trade for you, right? The one which we talked about, the lower time frame zone. But if you're okay with the trading zones which are not coinciding levels, it's perfectly fine, right? It's not mandatory it has to be a coinciding level, but if it is coinciding level, then you definitely get a little extra edge based on the boosters. All right. Were you a software developer before you started trading? No, I was not a software developer, but I did have computers as my one of the main subject. You know, so that is why I have a little bit of understanding of coding, right? So that's how it is. All right, sorry to join late. I'll be watching the recording. Not a problem. The beauty is, yes, these recordings are always available. In case you miss it, you can always go back and you can look into it. Very nice analysis. Thank you so much. How can I use the HVIV indicator? So in case you want to access the HVIV indicator, it's again absolutely free. But to get it activated, you just need to send an email to info@surjitkakkar.com. So Bharat, uh, just send an email with your TradingView username. Within 24 hours, it will get activated for you. In HIT, cannot be traded overnight, and then would it make sense to trade HIT zone when they, which has not been triggered, but type 1 after 10 to 20 days? See, again, when it comes to be that HIT trade or a DIT trade or a WIT trade or an MIT trade, let's say if it is triggering after 10 to 20 days, just because you waited for 20 days does not disqualify it, right? As long as it matches with your trade plan, even if it is after 20 days or even if it is after 20 months, so time does not disqualify the trade. The way we did the analysis, you'll have to do the analysis and check, does it qualify based on my trade plan? If the answer is yes, even after 20 days you can trade it. If the answer is no, even after 20 minutes you cannot trade it, right? So as long as it is qualifying based on your trade plan, it is a valid trade for you, be that after 20 minutes, be that after 20 months or 20 days. uh, See, again, we'll not be getting into options because these sessions are not inclined towards options. But yes, I do have a free course which is on options as well. You can go through that course content to understand options better. All right, perfect. So that brings us to the end of today's session. Thank you so much for joining in. I'll be seeing you now next weekend. Until then, trade safe. Enjoy your Sunday. Take care. Bye bye.